Covered call ETFs could be a great way to boost your income. We Europeans have access to a few of them. But how do they work and what are the risks? Cue the classical music and let's find out. Welcome back everyone, I'm the Swedish dividend investor. For today, we will look into covered call ETFs. Covered call ETFs might be appealing with their often very high yield. We do have to keep in mind, there is no such thing as a free lunch. There are risks to consider. So I thought I would share my understanding of them, what I look for and my reasoning for why I buy them. This video is especially for income investors, retirees or anyone thinking about trading growth or cash flow. But if you want some deeper knowledge on how these work, I would recommend you to keep watching. One thing I'm not covering today is taxes, because it's theft. Because they vary a lot depending on your country. But distributions from covered call ETFs can often be taxed differently than regular dividends. That's something you absolutely need to look up locally. As always, this is not financial advice. I'm just sharing my investing journey and my analysis. Read the full disclaimer in the description. So let's do a basic breakdown on how these ETFs work. So when you sell a call option, you give the buyer the right, but not the obligation to buy your shares at a fixed price in the future. When selling options, you collect a premium. So let's walk through a practical example. Let's say you have 100 shares of company X. The current value is $100. You sell a call option with 1 month expiration date for a strike price of $110. Let's go with a premium of $2. A buyer goes along and buys your option. You get paid $2 per share for the contract. He has the right, but not the obligation, to buy your 100 shares for $110 1 month in the future. Now, fast forward 1 month. Let's say in scenario 1, the company is still trading for $100. Why would the buyer execute his buying right here? Then he would need to pay $110 per share, and he has already paid $2 per share for the contract. So in total, he would pay $112 per share. He did have the right, but seeing as how he would instantly lose money, he chose not to execute his call option. You walked away with a profit of $200 and you still have your 100 shares. In scenario 2, after 1 month, the company is trading for $115. In this case, the buyer chooses to exercise his buying right. He gets the shares and sells them right away. And he just made $3 per share. So your shares get called away. You still made $112 per share, so a total of $1,200. But as we saw, the price continued to climb a bit. This is the capped upside we talk about with covered call ETFs. Now you're left with 11,200, but you own no shares. So now you have to buy them back at $115 per share. Let's say you have some extra cash on the side to afford the new price. Now you sell another call option, this time with a strike price of $125. Another buyer buys your contract. So once again you collect a premium of $2 per share. And just like before, let's do 2 more scenarios again. In scenario 1, the shares skyrocket to $150 per share by the expiration date. The buyer exercised his option. You still made your total of $12 per share. The buyer, on the other hand, he only paid $127 per share in total, making his profit $23 per share. Once again, this is capping the upside potential, since if you just held the shares from the very start, you would have made $50 per share in gains. So, in the second scenario, the shares tank, they fall down to $90 per share. The buyer backs off. You still collect the premium of $2 per share, and the contract expires worthless. You keep your shares, but now you're down from $115 per share to $90 per share. But you're cushioning the losses by $2 with the premium income. From there, the cycle continues, And if the shares keep climbing month after month and your shares get called away, you are still catching some of that upside, mostly in the form of premiums, but you lag behind in the price movement. Now, I know this sounds very complicated, but a good thing is you don't have to trade these options. The managers do that for you. So, this is what the ETF and the manager does, but on a whole portfolio of stocks. For example, the S&P 500 or the Nasdaq 100. I'm doing this so you know how it works, since you don't want to invest in something you don't understand. So, to summarize, you get high income, often monthly, at the price of capping the upside. But it also somewhat cushions the downside by providing income. Now, the numbers here are obviously just an example, and this is a highly oversimplified example, but I hope you got some insight on how covered call works. Some risks you might want to consider. When the underlying asset goes down, so does the value of the ETF. With a smaller portfolio, the total amount to write calls on shrinks, making less premium. This could be offset with the higher volatility during crashes, since premiums get more expensive with high volatility. Low volatility. You make less from premiums. V-shaped recovery. After a quick fall and a speedy recovery, covered call ETFs can lag behind severely. This is due to the capped upside. If the recovery is slow, they can keep up with the total return in the form of premiums, but when the market bounces back quickly, they will sometimes lag behind. Another thing to keep an eye on is whether distributions are actually earned through premiums, or if the ETF is slowly returning capital. A high yield looks great, but if net asset value keeps bleeding over time, that's a red flag. And the most important part, covered call ETFs almost always lags the underlying index or asset. This is a trade-off you need to understand. So, if you have a covered call Nasdaq ETF and the Nasdaq goes up by 20%, you might be flat with a 10% income. So, different managers have different strategies. Some ETF managers sell covered calls on 100% of the portfolio. QYLE and XYLU from Global X, for example. This really caps the upside. Some managers only sell options on 50% of the portfolio, like FEGI or ASWL from Rex shares. And some have a pretty flexible strategy where they adapt to market conditions. Then there is the so-called moneyness. Some sell their options at the money, so basically at the current share price 1 month out, and some sell out of the money, above the current price. At the money usually means higher premium, since it's deemed less of a risk for the buyer. Out of the money is less premium, since it's deemed more like a gamble for the buyer. I like out of the money better than at the money, since the risk of getting called away is lower with out of the money, capping more of that upside. That's just me though. So basically, this is the crash course on how call options work. There is a lot more to option trading, but it can get very complicated. Just a quick reminder, if you enjoyed these types of videos, make sure to like, comment and subscribe. Thanks. Now that you understand how they work and what the trade-offs are, let's talk about the most important question. Who should actually own these? And who absolutely shouldn't? Income investors. Some people want growth, and that's a good strategy. But for me, income is more important. You can create growth with income through reinvesting. I've shown this a couple of times in my videos. Will I beat the market every year? Who cares? I don't, as long as my income goes up and I'm nearing my income goal. Retirees. Let's say you're just retiring, but your state pension isn't that much, but you have some savings. Timing those sells with the market if you went with growth could be hard. A really bad year could erode most of that unrealized gains and your total value. If you held covered call ETFs, you could instead collect high yield, and even if the market falls by 50%, and let's just say they get 50% less premiums, you still collect a 4 to 6% yield on your money, and you don't have to sell a single share. Investors nearing retirement. Maybe you did some growth investing or dividend growth investing, but you're planning your exit in a couple of years. Shifting over to covered call ETFs could be a good strategy to boost your income, but also getting to know the asset type. Investors who won't be able or don't want to grow their portfolios massively. Now, every investor is different, but some actually have a set goal in mind and then want to live off of dividends or distributions. This could also be a 50-year-old with not much in net worth and a limit on how much he can save each month. Dividend growth investors. Now, you might not want to go all in, but a position or two of 5% each to boost that income could help a lot. Who aren't these ETFs for? Growth investors. If you want the highest total return possible, or if you aim to beat the market, covered call ETFs are not for you, since they usually lag the underlying. Young investors. The power of time when compounding is very powerful. Growth would be more suitable for you. Dividend growth investors. Yeah, it's on this list as well. If you're a pure dividend growth investor, you won't be getting much of that from these. Sure, you can create dividend growth from reinvesting, but the total return will surely be lower. Investors with small accounts. Honestly, you do you. If you have a small account and want to buy covered call ETFs, go ahead. I just think it's more powerful if the portfolio size is bigger. I would grow the account through growth and regular dividend growth investing. 10% of $1,000 is $100, but 10% of $500,000 is $50,000. The numbers are the same, but the income is very different. It's more suitable to use these ETFs if you want to withdraw the money sooner rather than later. Investors with very big accounts. Honestly, if you have over 1 million euros or dollars, you can easily get a big income with much less risk. Heck, even a 3 to 4% bond yield would produce a lot of income. And finally, investors who doesn't understand what they're buying. Now, this might sound pretty obvious, but I do think a lot of investors doesn't understand covered call ETFs. Some think, hey, I can get 10% in perpetuity and price growth without any risks. That's clearly not how this works. Now, I wouldn't go all in these ETFs. I like having some individual stocks, but for my strategy, financial freedom in the near future, these play an important role in my portfolio. My high yield videos are usually a hit or miss, but I do think this video can be helpful or educational, even if you don't like covered call ETFs. So, what do I look for when it comes to covered call ETFs? These are some of the rules, but I sometimes bend them a bit. Think of this as the best covered call ETF requirements. Monthly distributions. Always nice to have that monthly cash flow. Somewhat stable distributions. High yield. Now, I can be flexible here, but a yield exceeding 7% is something I'm looking for. But I also don't want the stupid high yield single stock or risky assets ETFs have with a yield exceeding 15%. Maybe somewhere in the middle, around 9 to 11% preferably. Out of the money strategy. Like I said before, I like this a lot more. Selling calls on 25% to 90% of the portfolio, optimally around 40 to 70%. Somewhat decent total return. I'm fine with lagging the index, I just want to make my income and have a somewhat stable share price. I'm okay with being down, since the market goes up and down, but I don't want to see a steady ongoing decline. Tops and bottoms are okay. Domiciled in Ireland, so I don't have to pay a withholding tax. Always take your tax situation into account and see how it fits you. So why do I buy covered call ETFs? Well, the income is pretty nice. I like the monthly and high cash flow, and I'm fine if I underperform the market. I'm an income investor. Sure, I do care about not losing money. But as long as my income grows at a fast but steady pace and I'm just performing, I don't really care that much. Some years will be great, like in a flat market. Other years, like when the euro and dollar is getting crushed, in combination with a downturn, I might underperform with these ETFs. This was the case for 2025, but I made over 7%. In 2022, I finished the year at break even, when the Nasdaq was down 32% and the S&P 500 was down 19%. Mostly thanks to my income producing assets, though I did not own any covered call ETFs back then, but I still invested into higher yields. Now, I don't think I want to be overweight in these ETFs as of yet, but time will tell how I might go about it in the future. I want to highlight an often used critique when it comes to covered call strategies. Some investors say, we don't know how a massive correction would affect these. Well, we kind of do, even though our examples are few. QQQX, Nuveen Nasdaq 100 Dynamic Override Fund, was launched in January of 2007, so just before the Great Financial Crisis. They have a current yield of around 8%. Scrolling down, we can see their strategy is to sell call options on 35 to 75% of the notional value of the fund's equity portfolio, with a 55% long-term target. And here we see their launch date as well. It is a closed-end fund, but it uses the same strategy as the ETFs. Now, I can't compare it to the S&P 500 or Nasdaq in that time frame using seekingalpha.com, since I'm cheap, frugal, and I won't pay for their premium service. But I found a total return chart versus the Nasdaq 100 going back to QQQX inception. This is with dividends reinvested, and I would say that doesn't look that bad. Scrolling down, we can see QQQ, that's the Nasdaq 100. They returned 1,562%. QQQX returned 587%, and annually, QQQ has returned almost 16%, while the QQQX has returned 10.68%. Now, I think that's pretty good. A long-term annual return of over 10% is very decent with this type of ETF. Now, this doesn't mean every covered call ETF will perform stellar, but we do actually have one data point on how they perform during really bad times. So, to sum it up, covered call ETFs are not about beating the market. They are about getting paid consistently while you're in it. You're trading some upside for income, predictability, and peace of mind. And for some investors, myself included, that trade-off makes a lot of sense. They are not perfect, they are not risk-free, and they're definitely not for everyone. But if you understand what you're buying and why you're buying it, they can play a very useful role in an income-focused portfolio. Let me know what you think. Do you own covered call ETFs? Are you considering them? Or do you absolutely hate them? I read all the comments, and I always enjoy the discussions, even when we disagree. But that's it for this one. I'm the Swedish dividend investor, and I will see you next week. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!